So Greg sent in this kind of question that we broke into three different parts. So the first part is regarding the U.S. debt. It appears that consumers have a relatively low debt level at the moment, while government debt is high. Will this not cause a problem if they keep raising interest rates? Will it not increase the cost of borrowing and eventually stifle investment, especially with such a tight labor market and baby boomers aging out of the workforce? Would, what would the effect of higher cost of government borrowing at the same time of lower tax receipts if they did manage to cool demand?
Yeah. So it's an interesting question. Basically, what we're saying is what happens when you raise rates? Yeah. And so one thing that does happen is that the government debt gets more expensive. When they're pushing out 2-year treasuries at a really low rate, now the 2-year treasury is more expensive, right? I mean, it's pretty simple. And so interest cost goes up for the government. Of course, corporations, right? Kind of three categories: government, companies, and people, right? Consumers. And so when you look at the kind of the companies, their cost of borrowing goes up, and they'll do less investment in that environment just because it's more expensive for them to borrow if that's how they're funding their business, which a lot of companies are. And of course, consumers, cost of borrowing, credit cards, mortgages are two big ones, auto loans, less likely to buy homes at 6% than 3%. Still going to buy them in a lot of cases, but less, right? Less likely to buy autos at a higher rate for the, auto loan if you happen to need an auto loan. That's what slows down investment in total. Now, the government also essentially invests. Their spending is part of the stimulus, right? So in case, some of it's very direct, like the infrastructure bill, right? They're going to spend money on infrastructure, they hire people, money's going to flow into the economy. Or the stimulus bills that they did, that's sort of an investment into the economy to kind of push things back up. You're going to have a lot more difficulty doing that when you're paying out a lot more of your totality, your total budget for interest, right? So the more the interest rates comes up, the harder that's going to be. I think the other problem right now for the government specifically is that we're in this high inflationary environment, and part of that is, like you said, from the labor tight pool and whatnot. But we've got this high inflation environment. We're not going to see a lot of stimulus coming out. Right? It just doesn't make sense. They're going to shoot themselves in the foot to do that and such. And matter of fact, that's one of the things that's really interesting. So here in California, they're doing this. They're going to send people money as a rebate on the gas tax, which sounds good, except for the fact that that's actually one of the problems. They keep sending out money, and it creates an inflationary environment. We're all going to be happy to get it, but it's actually an inflationary stimulus in a highly inflationary environment. So it's political. Probably get some votes. People will be happy to see the check, but maybe they won't be so happy if that means that their food prices continue up or whatever. So it's very. There's a lot of interrelationships here that are quite fascinating to look at, but that's how I would look at this question. Rates going up slows things down. That's exactly what they're trying to do. Do they slow things down so much that we end up in recession? Do we end up with a 40% downturn instead of a 20% downturn? Those are the questions that I'm asking all the time. But right thought process in the question that this is going to cost the government something also. Which is kind of fascinating because basically you have the government raising interest rates on themselves as well. So you wonder if there's some thought process there or not. But inflation got so high, it's what they need to do now. So good. So there's a second portion of this question, yeah?
Yeah, but you also have to think that as long as there's faith in the U.S. government to pay their debt obligations, they can raise their interest rates.
Yeah.
As long as people are willing to still buy those treasuries and there's no lack of demand. That's where the U.S. government has that kind of edge, is they're considered a safe haven currency. And so people in times of recession tend to flood into U.S. treasuries. And so that's a safe space for them.
Well, that's a really good point because kind of if you divide it up, the government can continue to spend even for higher interest rates or any of those types of things because they can print dollars essentially and issue new treasury debt. And there's a pretty willing and open market for that. And so even though the deficit might grow and what have you, and it costs more, as long as people are still willing to buy treasuries, and the U.S. is really fortunate in the fact that the dollar is kind of the main currency worldwide, and so that's an area that we still get money coming in. And because for as long as I've been in this business, people have been talking about the deficit being too high, and it's going to be this massive, problem from that. I still think that's definitely a possibility, but it hasn't happened yet. And the reason is because the U.S. is still seen as a safe haven. Money still comes in, and when things fall apart, and we have a big recession worldwide, like we did in 2008. You'll still see treasuries going up because people are buying treasuries, and that's what funds that deficit, which just grew because the receipts fell, right?
Mm-hmm.
Yeah. So very interesting.